Good morning to all. Today, this is a special lecture series program for undergraduate students, finance and its allied areas, organized by Kolkata Bidhannagar Society for Academic Advancement and coordinated by Azure Academic Services. Today's topic of discussion is direct tax management, and our guest lecturer is Dr. Professor Sayak Mitra, years Kolkata, India. Sayak Mitra holds MPhil degree and is currently pursuing a PhD in Commerce from the University of Kalyani. Sayak Mitra sir qualified for the UGC NET in 2018 and completed his post-graduation studies in the University of Calcutta. With over 5 years of teaching experience at the undergraduate level, he has authored in international books, contributed articles to journals, and his research interest includes corporate finance, financial management, behavioral science, financial markets, financial econometrics, and financial statement analysis. Welcome, sir.
Well, thank you. Good
Thank
morning,
you so much,
everyone.
sir. Please take over the session.
Yes. Thank you so much. Good morning, everyone. So, I'll be starting my deliberation on the topic direct tax management. So, before that, I'll present my screen. So, I think the screen is visible, right?
Yes, sir, visual.
Okay. Okay. So, I think this the my PPT is visible, right?
Yes, sir, visible. Please
Okay.
continue.
Okay. So, today's topic we have the direct tax management, right? Now, whenever we are going for the direct tax management, so basically our focus area will be uh, how to file returns, right? What are the applicable forms? How many types of returns can be filed under this income tax act? And before filing the return, we have to pay few taxes, advance taxes, self-assessment taxes, and there are some rules and regulations that we will cover. And lastly, we will cover the types of assessment done by the income tax department, right? So let us start with the initial section, which actually describes that uh, a person in India, if he earns some sort of income, he or she has to file return, and the section is actually under 139 subsection 1, right? So under this section, it has been told that a return of income is a self declaration by the assessee. So the assessee himself or herself has to self declare that he has some sort of income which comes under the taxable purview of income tax department, and before filing he has to pay the tax if something is payable as per his own assessment or her own assessment, and then uh, yeah, your filing can be completed, right? So non-filing, if you're not filing your return on time, so there are some due dates also I'll be discussing one by one. So if you're not filing as per the section 139 subsection 1, so some sort of penalty by way of interest, by way of late fees, it will be imposed on your tax liability, right? So now, before going to discuss these things, let us first cover up what are the main compulsory filing requirements. That means who are eligible or who are mandatorily have to file their return, right? So all companies and firm must file their return of income. So it's about loss and everything. So our basic focus will be on the individuals, HUF, BOP, AOY, artificial judicial person, this type of persons covered under this. So for that type of person, their total income, how we can get the total income after deducting the total amount of deduction available under chapter 6A from their gross income, we are supposed to get the total income. Now, if the total income crosses 2,50,000 as per old regime, then they are supposed to pay tax, unless not, right? If it is for a citizen having age less than 60 years. Now, a person having age more than 60 years, they are required to file their return if it crosses 3 lakh. One thing you have to be very clear here. Sometimes what happen, one person's income criteria doesn't crosses this 2 lakh or 2 lakh 50, whatever applicable for that person, but still the person has to file their return. This is called nil return, right? So return filing is a consistent thing, right? So every year, whenever you are you register yourself in income tax portal, then onwards you have to file your return irrespective of your actual income, right? So basically, when the return filing section will arise, for that purpose, these income criteria are being discussed. It's a mandatory thing, but voluntarily a person should file their return even if in a certain year they don't have an income, right? Now there are few more additional applicability for filing the return. If the business turnover is more than 60 lakh, mandatorily they have to file return. If they have professional receive more than 10 lakh, if they have some sort of TDS and TCS 25,000, more than 25,000, then they have to file their return unless they won't be able to claim the TDS they have deducted if something is refundable. And finally, if a person having deposit more than 50 lakh in any savings account, then that person has to file their return, right? Now, as we are discussing the filing of return and the eligibility, next thing that will be very important to know, the due dates, right? So due dates for filing return is not same for all type of person, right? If you are an individual, in that case your filing date or due date of filing is 31st July, right? So this is called general assessee or non-audit cases. Non-audit means as per section 44A, that person are not supposed to file their not supposed to audit their books of accounts before filing their return, right? Now, second one, 31st October. It is applicable for companies and audit cases. So, general under the general case, it covers up which type of assessees, generally individuals, HUFs, right? This type of assessees are covered under the 31st July section. But in case of company and those firms having the audit cases, that means their books of account should be audited before filing. In that case, the filing date is 31st October. And lastly, assessees, those who are required to furnish their transfer pricing thing. So for them, it is 30th November. But sometimes what happen, every year, as per the requirement or as per the demand of the taxpayer, sometimes income tax department or CBDT extends the date. Now, contextually in this year, this 31st July for the individual date has been extended up to 15th September, right? But please keep it in mind, for actual due date or the statutory due date in this case must be these dates, right? So if you are not able to file your return within that date, some sort of interest or penalty will be imposed on you, right? Now let us move to the different forms of filing ITR, right? So we have discussed that when the tax filing or in ITR filing sections are there, and if you are supposed to file the return, then you have to secondly know that what are the types of return you have and which return is applicable to you, right? So it's a very confusing thing. So some people are actually get confused that which return for him it is applicable. So please look at this in in detail. So we will be discussing this. First of all, ITR. There are seven types of ITR can be filed based on the nature of the assessee, right? And based on their income and income sources, right? So if you are an individual and having income from salary, so usually you are supposed to file ITR 1, which is called Sahaj ITR, right? So what are the basic condition for being for filing this ITR 1? You have to be an individual resident in India. Your income must be up to or must be less than 50 lakh during one previous year, and this income should be from three particular heads: salary, only one house property, and few other source like savings, interest, and all these things. If you have income from these three heads, then basically you are supposed to file ITR 1. Now, this assessment year onwards, one additional point has been added with ITR 1, that is the capital gain. If you have some sort of capital gain by transfer of equity shares or equity oriented funds under section under section 112A, that is 112A, up to 1,25,000, then you have to disclose your uh, total value of consideration and the associated cost here. And also, if you have some sort of agricultural income up to rupees 5,000, you have to disclose, but it will not be a taxable part, because we know that agricultural income itself in India exempted under section 10 subsection 1, right? So if all these conditions are being fulfilled, being an for an individual, so then they can file the ITR 1. ITR 2 is applicable again for the individuals and HUF, but few difference is there with this ITR 1. ITR 2 is to be filed if your income is more than 50 lakh. So now see, if your income is up to 50 lakh, then it was ITR 1. Now, if it crosses 50 lakh for an individual and now HUF, then it is ITR 2 to be filed. And basically, ITR 2 consists of all the previous as discussed in ITR 1, but along with that, new things are added, that is the capital gain. And if you have more than one house property income, then all income should be disclosed under ITR 2. And if you are a director of any company and having unlisted shares, then you have to disclose this in ITR 2. And lastly, if you have any income from foreign assets, if you have any foreign assets like shares, FPI investment, FDI investment in other countries, foreign countries, then it should be you are supposed to file the ITR 2. ITR 3 is basically again for the individuals, but first time it is mainly dedicated for those person having income from business and profession. So any person having income from business profession, but that person is an individual, in that case, ITR 3 should be filed, right? And if you are getting remuneration as a partner of a partnership firm, then also you have to file ITR 3. ITR 4 is called Sugam ITR. It is again for the individual, but the difference is this is to be filed when your income is less than 50 lakh, having one house property, if even if you have salary income, then also. But one thing is, it is basically to be filed for that purpose. That is, if you have some sort of professional income or business income, which you are not keeping for this, you are not keeping any books of accounts regularly. So this is called the presumptive taxation income. And if it is less than 2 crore for a business and more less than 50 lakh for a profession, then you are supposed to file ITR 4. So ITR 4 and ITR 1 is almost similar. Only the difference is, if you are having income from any profession like medical profession, accounting profession like chartered accountants, law profession. So in that case, you are not, and at the same time you are not maintaining your books of accounts regularly, then your appropriate ITR will be ITR 4, right? ITR 5 is applicable basically for the firms, including the limited liability partnership firms as well as AOP BOIs. AOPs means association of person like clubs, societies, etc. For companies other than the company claiming exemption under section 11, so basically ITR 6 is dedicated for the registered companies. It includes private and public companies. And lastly, ITR 7 is basically for the artificial judicial person. That means one legally formed person. For that purpose, this has been actually filed, like any trust, any temple trust, right? This type of thing, the ITR 7 is to be filed. Now, as we have understand that how many types of files are there and which file is applicable for which type of SSC. So second thing that we are supposed to know, that is how to file and the verification, right? So I'm not discussing in detail the filing process, but whenever you are going to file your return, it can be verified using different sources or different techniques, right? So verification firstly is of two types: online verification and offline verification, right? So whenever you are filing your return, you have to verify. that your return and your all the things are disclosed by you are exactly right or best or the right one to the best of your knowledge, right? Sorry. Now the thing is, whenever you are uh, verifying these things, then if you use the online mode, so there will be basically three or four way of verification. First one, using digital signature certificate. So it's a separate utility you have to install in your computer whenever you are filing, and you can authenticate your return or verify your return using that particular mechanism. So you have to obtain this DSC certificate separately from the authorized authorities, e-Mudra, and there are other also verified by the income tax department. From them, you have to obtain this DSC certificate. It's a type of it's a basically e-certificate type of thing, right? So it's a verification way you can verify your ITR. Most easiest way of verification is using Aadhaar OTP. So you can use your Aadhaar OTP for verification of your ITR. It's a very easy thing. So you have to put your Aadhaar card number and link to the UDI portal, and you will be receiving one OTP in your registered mobile number with the Aadhaar, and that you have to enter there, and then you can go for the go and proceed for the submission after verification. Third way of verification we call it is electronic verification code. It is not the DSC, not the OTP. So you can also verify using different electronic mode if you have that accounts. Firstly, you can use your bank account or your Demat account for verification. So using the portal or gateway of the Demat and your bank account, you can verify your return. And you can also go to your bank ATM and get generate the pin, and using that pin you can also verify the return. And lastly, you can use your internet banking facilities also to verify your return, right? So before going to verification, you are supposed to know that you have a registered user ID. Basically it's your PAN number and a password, right? Okay, so this is all about online verification, and lastly you have the offline verification. So it is basically the you have to file your return, you have to generate the receipt certificate. It's called ITRV, and after generation of the ITRV, you have to take a printout and send it to, after signing, you have to send it to the income tax authority using the postal service. This is a physical or offline way of verification, right? But mostly today, the online verifications are popularly used for the verification of ITRs, right? Now, before going to discuss this thing, firstly, you have to know two very important document required for the income tax filing purpose. Not only filing purpose, for other purpose also. That is a TAN and PAN, right? Now, what is a PAN? PAN is a permanent account number, and TAN is a tax deduction and collection account number. Now, what is the difference? Both are the identity of the taxpayer, and second one, that is the PAN, is the identity of the taxpayer. That means who is actually supposed to pay tax. He should sorry, obtain one PAN number, and it should be allotted by the income tax department itself. And what is TAN? TAN is that identity of a tax deductor who deduct tax on behalf of a person and deposit the same in the name of that person to the government, right? So TAN is basically to be obtained by the person who is the deductor. That means before payment to any person, they are supposed to deduct the tax, and then they have to pay the amount to them. And for that purpose, they have to quote their TAN number. And at the same time, PAN should be quoted by the person who is actually liable to pay tax. Basically, for like us. So we are the individuals and we are supposed to pay the tax. So we have to quote the PAN. We should not have the TAN number. So basically, TAN number is actually TAN number is required for deducting the tax. So if you are a if you are an employee of any company, so then the company, before paying you the salary, they will deduct tax, then they will pay you the salary. So they have to obtain the TAN number, right? So TAN number and PAN number, these two are very important thing. The structure, it is a 10-digit alphanumeric code. So it's a 5-digit alphabet, then 4-digit code, and then again one alphabet. This is a structure of PAN. And for the TAN, again, it is also 10-digit, but the structure is a little bit different. First, uh, 5-digit is alphabet. Next 4-digit is it's a first sorry, it's a mistake. So it will be the first 4-digit alphabet, 5 numbers, and last there will be one letter, right? So it's a format for a TAN and PAN. So only one thing you have to keep it in mind, that a PAN is required when you pay tax, and TAN is required when you deduct tax before making payment to someone else, right? Okay, so I think this part is clear, right? So if you have okay, so now types of return, right? So whenever we have done the forms, that means which forms we are supposed to file, then we have to know one thing, that is how many types of return we can file. Now first I'm just making it clear, form of return and types of return are not same. Form means which form you are supposed to fill up before submission or during the submission of your ITR. And types of return means which type of return you are supposed to file, right? So there are different types of return. So whatever we have discussed at the beginning, section 39 139(1), this is called the original return of income. So firstly, before anything, you have to file this ITR, or the original ITR, as per section 139 subsection 1. But apart from that, considering different situations arises, there are different types of returns can be filed, right? So the first one, return of loss. So what is the return of loss? Separately, if as per section 139 subsection 3 of Income Tax Act, a return of loss must be filled within the due date under section 139 subsection 1 to carry forward the specific losses like business loss, capital loss, speculation loss. So if you have some sort of business or capital loss type of thing, so separately, apart from your normal return or original return, you have to file your return of loss. However, loss of house property and unabsorbed depreciation should not be filed here. So you have ITR 2 to be filed to disclose these things. Filing is the assessee's responsibility, and absence of this, you can get a notice from the assessing officer that you have not filed the return of loss. So if you have a significant loss from business, capital gain, and some sort of speculation activities, then you have to file the ITR, the return of loss, right? As per section 3, 139 139 subsection 3, apart from your original return. Next one is belated return. So what is belated return? So from the name we can understand belated. So it is basically if any person not able to file or missed the due date. So what is the due date for an individual? 31st July July of the assessment year. So if our current assessment year is 25-26, so the due date for filing of the current assessment year is 31st July 2025. Right? So if a person miss this date to file their original return as per section 139 subsection 1, then he or she has the option to file a delayed or belated return. But there is also again one due date for filing the belated return, right? So belated return should be filed within 31st December of your assessment year. So if our due date for the assessment year is 31st July 2025, and if we miss the deadline, then we can file the same return but within 31st December 2025, right? So it is very important to know that belated return can be filed if you miss your filing for section 139 subsection 1 within the original due date, right? Next thing is revised return. So what is revised return? Section 139 subsection 5 is discussing about the revised return. So what do you mean by revised? From the name we can understand, if a person files return So earlier that person has filed. So the difference between belated and revised is belated. In case of belated return, the person has missed the deadline. They have not filed at all. You are filing first time within the 31st December of the assessment year. But in case of revised return, earlier the person has filed and filed within the due date also. But after filing, he has discovered some sort of omission, some sort of incorrect statement as per his knowledge. So that is why he wants to revise this return, right? So first of all, for revised return, you have to file within the due date, unless you won't be able to file the revised return, right? So please be very careful about that. So if a person files return under section 139 subsection 1, that is original return, and sometimes if you are filing belated return also, you can get some sort of uh, or you can identify some sort of misstatement or wrong statement. So you can revise this return, but also for the revision, the last date is 31st December of the assessment year. So if we just go through the sequence, so you can go in that way. Original return is to be filed by 31st July 2025 for the assessment year 25-26 as per 139(1). If you are filing belated return, due date is 31st December, but you have to file the belated return before the 31st December. And if you are having some sort of correction, if you are required some sort of correction, in that case, within 31st December, you can correct both the original filing, or if you file revised return, belated return after the due date of filing. But all the dates should be done by 31st December of the relevant assessment year. So in our case, the date is 31st December 2025. So I think this part is clear. Sorry. Updated return. So now what is an updated return? So apart from all these things, sometimes what happen, uh, updated. So you are supposed to file an updated return. So updated return is not an belated return, not an revised return. Updated return is a separate return, right? Updated return is a separate return. As per section 139(8)(a), it can be filed within 24 months from the end of the relevant assessment year, even if no original and revised return was filed earlier. Suppose you are missed the deadline of 31st July as well as 31st December. In that case, you have still the option to file your return, but within 24 months from the end of the assessment year. So your assessment year will be end on this 31st March 2025. So still starting from that day, you can file within 24 months one updated return, right? Now, one thing, whenever you are filing updated return, please be very careful, or keep it in mind one thing. If you are filing the return and if it is a return of loss, right, or sometimes when you are filing your updated return, it reduces your tax liability, increase your return, or if any assessment on reassessment you are doing, then it will not be permitted. So what does it mean? If you have missed the deadline, you can file. But if you want to update your earlier return and to take the benefit, so you are thinking that yes, I need an updation in our earlier filing return, or I need to reassess my return or recalculate my tax liability, and there is an ill objective that by doing this, we will take the benefit of reduction of tax, and we are showing a huge amount of loss, right? So these activities are not permitted. So only if you are filing your return and you are disclosing whatever the information was available earlier to you, just that is permitted within 24 months from the end of your assessment year. No modification restatement can be done after 31st December, right? So revised return, if you won't be able to file, you can file updated return, but please keep it in mind, you can't revise it then, therefore, right? You have to file the original data and original, you have to disclose original data or original information regarding your return. I think this is clear. Now the defective return. It's a last type of return we have to know. Section 139, subsection 9. If an assessing officer finds a return defective, they may notify the assessee to rectify within 15 days. So it is extendable as per the discretion of the assessing officer. So failure to rectify this make your return or earlier submission of return was invalid. But if corrected before assessment, the AO can condone the delay. A return is defective if key income details or proof of tax payments are missing. So it is basically not to be done by you. It is basically to be done by the AO. AO means assessing officer, the person who is assessing your return, whatever you have uploaded or disclosed the income, right? So after scrutiny, I will be discussing the type of assessment. There I will discuss. So after scrutinizing your return, the income tax department assessing officer, those who in charge of your scrutiny of your return, they can find some sort of misstatement, right? They can find some sort of error, or they can identify some sort of your objective to suppress your income. So in that case, they can send you a notice, and they can this notice means if you're getting some notice under section 1, under section 139 subsection 1, subsection 9, then it is called the defective return. Whatever you have earlier filed, it has some sort of defect. That is why you are getting this type of notice from you. So within 15 days, you have to rectify this. They will give you an opportunity. If you don't rectify within the date specified by them, then your earlier filing will be considered as a defective return, and your some sort of interest will be charged on you. Right? So please be very careful whenever you are start filing the return, and keep all the dates, deadlines, and types of return in mind. So I think this part is clear. Now, what we have learned, that how many types of return are there, how many types of return forms we can file. Now, one thing we have to know here, before filing of your return, keep it in mind, before filing of your return, some sort of tax you have to pay. Without payment of tax, if obviously your income comes under the taxable purview, and when you compute tax, there is a positive tax payable which is greater than zero. If in that case you are supposed to pay tax, before filing you have to pay tax. You have to clear all your tax dues and liability before you file any of the return we have discussed. That is basically original return, or you have to, if you want to file the revised return, belated return, then also before that you have to clear all the dues to the income tax authority by way of your tax, right? Now regarding the tax payment, regarding the tax payment, there are two types of tax basically will be imposed or will be charged on the assessee. Two types of tax means there are two way of collecting tax. Either you can pay your tax in an installment basis starting from the financial year of your assessment, and secondly, directly during or before filing of return, you can directly pay that tax to income tax authority, and then you can go for the filing. The first case is not up as per your choice. If you want that I will pay my tax in installments and you are paying, it is not possible. It is a compulsory situation I'm discussing. So then you have to pay this, or you have to pay the tax using the installment system. This is called advanced tax payment, right? And a second type, without payment of the installment, one time if you are paying the tax before filing, this is called self-assessment tax. What? Self-assessment tax. You have assessed how much amount of tax you are supposed to pay, and you are paying. There is no such question of installments, right? So we will be discussing this difference in detail. Now let us first discuss what are the conditions for charging the advance taxes, right? Not, please be very careful or clear that not all type of assessee has to pay advance tax. Advance tax incidence will start if an assessee having income during the year uh, having income during the year, and his total tax liability. Total tax liability includes gross tax liability plus cess, that is health and education cess. So if the total tax liability and after deducting the TDS payment. Now what is the TDS payment? TDS means tax deducted at source. So whenever you are being paid, actually I'll be discussing in detail. So just I'm giving you an idea. TDS is a compulsory payment. The tax deductor. When I was discussing the PAN and TAN. So I have told TAN is the tax deductors account number. So those who are deducting TDS before making you the payment, they will deposit the same in your name to the income tax authority, right? Now whenever you are going to file your return, you can claim the TDS if your tax payment is less than the amount of TDS deducted, right? So advance tax payment is only arises after calculation of your total tax liability and after deducting the TDS applicable on the total tax liability. Say for example, your total tax liability is 50,000 and you have earlier TDS deducted is 20,000. Now, what is your net tax liability? Already 20,000 has been deducted earlier by way of TDS. So now net you have to pay 30,000 tax. Now this 30,000 amount is how much? It is more than the 10,000. So only the situation when the net tax liability after deducting this TDS, it exceeds 10,000 in any year, then compulsorily you have to pay the advance tax. So it is not required for everyone. If you are having income and you are calculating your tax liability after deducting the TDS, if your total tax payable is more than 10,000 only, then in that case you are supposed to pay advance tax. Now what is the schedule? I am just discussing one by one. Now there are some exemption and some applicable criteria, right? So who are not supposed to pay advance tax even if they're having tax liability more than 10,000, right? So basically, if a person having age more than 60 years and that person having no income from business profession, then that person is not liable or required to pay advance tax, irrespective of liability. It means even if his tax liability is more than 10,000, but still the age is more than 60 and he or she does not have any income from business profession, he is exempted from paying the advance tax. They will pay directly the self-assessment tax, right? And nextly, some corporate and non-corporate agency also follow the rules, so it is not applicable for this type of things. So please be very careful that it is applicable to whom? Individual assessees, firm, companies, and trust. So it is usually applicable this type of assessees, right? A resident individual having age more than 60 years or more and having no business and the professional income is not liable to pay advance tax, right? So it is not applicability, right? Now the due dates. That's a very, very important and crucial for advance tax. When we are supposed to start payment of advance tax, how much we have to pay in different installments. So please be very careful that when your advance tax liability arises, that is more than 10,000, then you're not supposed to pay this advance tax more than 10,000 at a time or one time. Only the case of presumptive tax. I'm coming to that. So if you are a general case, that means you are having income, having total tax liability more than 10,000 after deducting the TDS, then there will be 4 installment. By this 4 installment, you have to totally pay the amount of tax, right? And that is due on your side. Now, but there are 4 due dates, right? So there are first installment is due on which day? 15th of June. But please be very careful. These due dates not relating to your assessment year. These due dates starting from your previous year or your respective financial year. Now in our case, what is our financial year? 24-25. So the first due date will be 15 June 2024. Next due date, so within that date, how much you have to pay? 15% of your total tax liability. I have a one case study on this, so then I will discuss in detail this. Sorry. Second installment you have to pay by 15th December 2024, and within that date 45% of tax is to be paid, but keep it in mind it should exclude this previous payment. So by 15 June 2024 you have to pay 15% of total tax. Say for example your total tax is 1 lakh. So by 15 June 2024 you have to pay how much? 15,000. Now by 15 September 2024 total you have to pay 45% including the previous payment. So previously so what is your total due amount on that day? If your total tax liability is 1 lakh, then it is 45% of 1 lakh, so total 45,000. Now within this 45,000 already you have paid in first installment 15,000. So now the rest portion 45 minus 15, 30,000 amount of tax you have to pay. Right? So I have one case study on this, then I will discuss. Third installment, it is due on 15th December of your previous year. So 15th December 2024 in our case. So by that day you have to pay total 75%, but excluding the previous two payments. Right? So your total tax payable is how much? If your total tax payable is 1 lakh, so it is 75,000. But already you have paid 45,000, 15 plus 30. So it should be reduced by this payment. So net payment you have to make how much? 75,000 minus 40,000, 45,000. So it is around 30,000. And lastly, it will be paid. Last installment should be paid by the end of 15th March 2025. That is your assessment year. But if this 15 March 2025 you are not being able to pay tax, at least you have to do this anyhow by 31st March. 15 days grace can be given for that. No such additional charges will be there. But if you are not able to pay all these due dates, and again, whatever amount of tax at least you have to pay, if you are paying less than that, some sort of interest liability will be imposed on you. Some sort of interest liability will be imposed on you. I'm again telling, if you are failing to pay advance tax, if you are missing the date, and at the same time, if you are paying lesser amount of tax as per the total number of installments and the minimum amount of payment, then in that two cases you have to pay interest. Right? So that interest are covered under two different sections. Section 234 B, it is a total due on total due of tax basis, and date wise shortfall if you have, then it is section 234 C. Right? So I'll be discussing these sections. Okay. Now I'm just showing you an example. Now this is a case study, right? So here some income components given: business income, income from house property, and interest from bank deposits. Right. So you're supposed to find out the advance tax liability or due dates of installment. Right. So if we just go through this advance tax liability schedule, so before that we have to find out the total income. I think these PDFs are visible. PDFs are visible, na? Hello. PDFs are visible.
Yes, sir,
So
visible. Please continue.
okay, okay. Now the thing is, compute advance tax liability if any as on the different date. So here we have the calculation. So I'm not going to in detail the calculation because it is not our matter of discussion. So what is our matter of discussion? That is the advance tax liability. So we have the GTI 18,45,000. Then we have a deduction, and the word net taxable income or total income is for 17,45,000. Right now, after calculation of the tax, and I'm just telling you that I'm following the old regime, right? So our gross tax liability is 3,36,000, and earlier we have deducted the TDS. Sorry, gross tax liability is 3,49,440, and earlier we have deducted TDS. That means whenever we have received the income, those who have given us the income, they have deducted the 60,000 TDS. So what is our net tax payable? 2,89,440. It is our net tax or a net advance tax liability. It is rounded off to the nearest multiple of 10. Right? So 2,89,440 is our total advance tax liability. So obviously it is more than 10,000. So that person is liable to advance tax. So I think this part is clear to you. Now, what is the amount of payment of tax, minimum amount of payment of tax that person has to make, right? So the due dates, first due date is 15th of September, 15th of June, sorry. So by that date, what is the total amount of tax liability, advance tax liability? 2,89,440. So out of this 2,89,440, 15% at least should be paid by this date, right? If your due date is 15th September 2024, there is a next due date. By that day, at least you have to pay 45%. But keep it in mind, whatever the amount you are paying actually now, it should be reduced by your previous payment. So the net amount of payment you have to make, right? And 75% by to be paid by 15th of December 2024. Its amount of rupees, but it is a cumulative. So previous two payments should be excluded and the net amount to be paid this day. And the last one, 15th of September, 15th of March 2025. Out of this total amount, you have to pay the total 100%, but it should be reduced by all these three payments and the net amount of payment of tax to be paid here. Right? So I think this advanced tax basic concept is clear to everyone, right? Okay. Now, what is our discussion? If now the question comes, if the person fails to do so, right? So in a given question, one point I have added: if the taxpayer payment schedule is as following. Now see what is the payment schedule and the amount of tax payment, right? So if you just go through this, you can understand what is the amount of tax payment: 25,000 by 14th of June 2024. Okay, here the dates are given in a different way. Why? It is not necessary that if you are supposed to pay by 15th of June 2024, you have to pay only on 15th of June. You can pay earlier, but not after or on or after. You can pay on 15th also, but you can't pay after 15th June 2024 for the first installment. The first installment should be paid within 15th of July, 15th of June 2024. Right? So our actual date of payment is 14th. So by 14th, we have paid how much? 25,000. By next day, that is by 15th, we have paid 90,000. Separately, this is the payment amount. Next, by 15th of December 2024, we have paid 75,000, and 12th of March 2025, we have paid 60,000. Now, what is the total payment? 2,50,000. Right? Now, see what was our total amount of tax. Total amount of advance tax to be paid is how much? 2,89,440. But actually, whatever amount we have paid, 2,50,000. Now there is a shortfall. There is a difference between 2,89,440 and 2,50,000. This shortfall is called this shortfall attracts one penal interest of 1% per month that is due to short payment of advance tax under section 234B. So if you have this type of shortfall in amount for the payment of the total tax, then one type of additional penal interest you have to pay 1% per month basis, right? Now, sorry, on the shortfall, this 234B is to be paid by you. Okay. Now, the 234B, whenever you are supposed to pay this 234B, then on from which date you are supposed to charge this interest? Keep it in mind, it is starting from the 1st April of the assessment year. So interest you have to pay or to count monthly basis 1%. Now, from which day you have to start payment of this interest? Starting from the 1st April of your assessment year. So what is your assessment year? 25-26. So what is the first day of your assessment year? 1st April 2025. So since that day till the date of payment you have made, so per month 1% you have to pay tax. Now see this. What is in this given case? I have given one case. So if you are if the return is filed on 139 section 1 is the original section on 24th June 2025, right? So here in this case, now see what is the actual amount you are supposed to pay? 2,89,440, right? But actually you have paid 2,50,000. So what is the difference? Shortfall amount 39,440, right? Now starting from 1st April 2025 up to the date of filing, because you are filing within due date, right? You are filing within due date. So in that case, starting from the 1st April 2025 up to the date of filing, you have to pay 1% per month interest on the shortfall value for the 4 months. 4 months means April, May, June, July. For the 4 months, you have to pay the interest under section 234B. So here the amount is 1578. So I think this is clear. Okay. Now, as we have paid this 234B for the total shortfall, but at the same time, if you are making shortfall for the respective installments also, apart from 234B, you have to pay interest as per section 234C again for the date-wise shortfall on interest. So now what is the date-wise shortfall? So here at least the rule is at least you have to pay 15% of this. But if you have paid less than 43,416 during 31st 43,416 within 15th of June 2024, then you have to pay penalty for this short payment of first installment. Secondly, for the second installment, third and fourth, if you make date-wise shortfall, like the total shortfall. So there will be two sections applicable or two interests applicable. One is 234B for the total shortfall as well as on the date-wise shortfall if in. Now see in our case, what is a date-wise payment? So minimum amount payable 42,416. But for the first installment, actual amount we have paid how much? 25. So within that date, there is a shortfall. Shortfall amount means difference between this 40,000 and 25,000. Am I right? So this is a shortfall amount, 80,416. Now on the shortfall amount, 1% will be charged interest till the next due date or next installment date. Next installment date falls on 15 September. So starting from the June, July, August, for the 3 months, 1% on the short date wise shortfall amount 18,416, you have to pay interest under section 234C apart from your 234. Again, for the second case, 45% of the tax is to be paid, right? But total amount you have paid how much this time? 90,000. But earlier we have paid 25. But we have to include both of this. So total amount payable by this day is how much? 1,30,248. But earlier we have paid 25, now we have paid 90. So total amount we have paid how much? 90,000 plus 25,000, right? So still there is a shortfall. So if you minus both this payment from 1,30,248, so this amount is 15,248. It is your shortfall amount. Now again on the shortfall amount, 1% per annum up to the next installment date for the 3 months, you have to pay interest. So I think this is clear. Now again for the third installment, 75% total minimum payable amount is this, but you have paid 75,000 this installment. So total paid till that date is how much? Total paid it is 75 plus 90 plus 25. So all this amount is to be deducted from the 2,17,280, but still there is a shortfall. Now again on the shortfall, you have to pay interest 1% for the 3 months. This is 812.40, right? And for the last year or last installment, better to say, so it is 2,89,440. There is a total payment to be made, but we have made only 60,000. Now previous payment, if we accumulate all the payments, so 25, 90 to 75 and 60, so total it will be 2,50,000. But we are supposed to pay how much? 2,89,440. So this 99,440 is your shortfall amount, and here you have to pay 1%, but not for 3 months, because this is a last due date, so it is only for that month. So it is a 1 month interest. Now considering all the 4 dates interest, your final total amount of interest under section 234C will be 2817. I think it is clear. Any query? So now the thing is, here, apart from the 234B, again we have to consider the interest of 234C. So total interest, how much you have to pay? For 234B, it is 1,578, and for 234C, it is 2817 that we have calculated. So total interest we have to pay 4,394. Now, total payment before filing of return, how much you have to pay? Your shortfall amount of interest plus all the shortfall amount of tax plus 4,394 by way of your total interest under section 234B and C. So total you have to pay by way of self-assessment tax. Now self-assessment tax means what? Whenever you are filing the return, you have to pay if any shortfall or if any interest are there. So before filing, you have to clear all the payments, unless you won't be able to file. And also, whenever you pay the tax, one challan will be generated. Now this challan, in this challan, there will be one number and date given. So whenever you are filing this, then this date and the unique reference number should be quoted there, right? So this self-assessment tax paid under section 234A at the time of payment will include all your shortfall by way of total tax liability, all the interest. So total 43,834. But if we have to round off, so keep it in mind, whenever you are paying or something or receiving something from income tax, they will make it round off. So if we round off, so it will be, if it is more than 5, then it will be 840, unless it will be 830. So if you round off, it will be 43,800, 43,830, because it is less than 5. Okay. So this is the case. So if you file within due date, but still you are having shortfall on total payment of tax advance tax liability, as well as you are making shortfall for the installment date wise, then you have to pay interest under section 234B and 234C. Right? So I think this part is clear. Okay. Now self-assessment tax, that I'll be coming later. So before that, I'm also pointing out the important thing, that is If we file within due date, then whatever the tax consequences and interest consequences we have learned. Now the question will come, if we are filing belated return, right? So it will be basically 4, right? So if you are supposed to file your original return, but after the due date, so what is the due date in for an individual? 31st July 25 for our case, right? Now, actually, now see when the file is actually done, 24th of November 2025. Still, the date is not appeared, but just for your understanding, I'm given. So, 24th of November 2025. Now, within this date, so you are filing, but for the previous case, it was before the due date. So, only you have to calculate whatever the interest till the due date. But now, here, you are making all the previous shortfalls, and also filing date is beyond the due date. So in that case, two additional interest and late fees will be added with section 234B and C. Right? So let us discuss this thing. So here 234A, it is 1% per annum to be charged if you make or if you fail to file your return within due date, the original return. So apart from 234C, C and B, if you are failed, if you fails to file your return within the due date, then basically you have to pay interest as well under section 234A, right? As well as if as you are failing to file your return within due date, just for few years back, since few years back, this section has been inserted. There's a default fee, or there is a type of penalties, we can also say. So if you are failing to file your return within due date, apart from all the interest, it will be charged obviously. But apart from that, if your total income is more than 5 lakh, then maximum 5,000 fixed late fees will be charged on you. But if it is less than 5 lakh, it is maximum limited to 1,000. So to sum up, if you are not filing your return within due date, there will be there will be 3 interest consequences plus 1 late fee. 234B, if you are making total shortfall on payment of total advance tax. If you are making date-wise shortfall, then 234C interest will be applicable. If you are not filing your return within due date, 234A per month basis, interest will be applicable till the date of actual filing on the shortfall amount. And lastly, a fees will be added, a fixed amount of fees if your income is more than 5 lakh. So a fees of 5,000 will be added as a default in furnishing of return under section 234F. So all these consequences you have to be aware of whenever you are filing your return. Right? Now see, in our case, the date is 24th November 2025 and all the previous information are same. Now here, apart from the 234B and C, 234A consequences will also be there. Right? Now see, 234A consequences will start from which day? What is the reason for 234A? Non-filing of return within due date. So our due date is, in our case, due date of filing 31st July 25. Now you can't charge interest, or the income tax department can't charge interest before the due date if you won't file, because at least till due date you have to give chance. Right? Sorry. So under section 234A, interest will be charged just the next day of the due date. So if the due date is 31st July 2025, it will start from the next day, 1st of August 2025. Right? So starting from the 1st August 2025 up to 24th November 2025. But one thing, keep it in mind, it is also applicable for 234B, C, etc. If you are having a part of the month, so here 24th November 2025. So if you just calculate date wise, that is starting from the 1st August. So throughout the month of August, throughout the month of September, throughout the month of October, and 24 days in the month of November. So there will be 3 months and 24 days. So for that purpose, you are supposed to calculate interest. But no, if at least one day will fall in any 1 month, but the rest days are not followed, you are paying before the rest of before the end of that month, it will be regarded as the total month was within the non-filing or within the default case. So here total number of month of default will be August, September, October, as well as whole November. Because if you are having any part payment, or if you are making before end of the last day of the month, but still income tax will charge total tax on that month fully 1%, right? So the date will be 1st of October, 1st of August 2025 up to 24th of November 2025. So it will be of how many months? 4 months, right? So during these 4 months, you have to pay your interest under section 234A for non-filing of return within the due date. Now question will come on which value you are supposed to calculate. Again on the shortfall, whatever we have calculated for B. Now here in this case of B also, there will be a change in calculation. Why? Because previously the due date was 31st. Within the due date we have filed, but now we are exceeding, or we are filing beyond the due date. So it will start from 1st April as well, but it will end till the date of your actual payment or actual filing of return. So you are filing your return on 24th November. So it will be extended up to 24th of November. So for how many months it will be there? So first April, May, June, July, August, September, October, November. Total 8 months, 1% on the total shortfall price. You have to calculate interest under section 234B. So I think it is clear. 234B applicable for 8 months. 234C exactly same, because date wise we have made the shortfall. And additionally here we have 234A because we are not filed within the due date. And here in this case the gross your total income is how much? More than 5 lakhs. So as we are not filing within due date and we are having total income more than 5 lakh, in that case, apart from all the 3 interest under section 234 ABC, we have to pay a late fees of 5,000. So now the question will come, total amount of payment by way of self-assessment tax before filing will be how much? Shortfall interest, shortfall amount of tax, whatever you have not paid, plus interest under section 234A, 234B, 234C, and late fees. All together it will come 51,990, rounded off. So just check, as the due date of filing is different, now there is a huge difference regarding the total amount of interest and late fees paid. Right? So this is the case of advance tax payment, and if you are not paying the advance tax within due date, these interest consequences and late fees consequences will be there. Right? So I think that the concept is clear to everyone. Right? Now, self-assessment tax is what? First of all, I'm telling you, self-assessment tax is not an advance tax. Advance tax should be paid within the previous year. Or it is a separate case or exclusive case which is to be paid. Advance tax should be paid within the end of the previous year. You can't pay advance tax as your previous year ends. But self-assessment tax is paid during your assessment year, and obviously whenever you are filing your return before that. And why this particular type of tax is known as self-assessment tax? Because you are paying this tax as per your own assessment. You have assessed by yourself and you are paying the tax, right? So whatever the rest part we have discussed, these 43 and these 51, these are the self-assessment tax. Why? Because if this self-assessment tax includes all sort of tax payment, interest liability, fees, but keep it in mind one thing, advance tax is to be paid mandatorily if you are having income more than 10,000 or having income tax more than 10,000. But in case of the self-assessment tax, there is no such rule. If any positive tax liability is there, then only you have to pay self-assessment tax before filing. Self-assessment tax to be paid in the assessment year before filing, but advance tax must be paid within the end of your previous year by payment of different installments. No interest charged on the advance tax. So when you are paying advance tax, then nothing interest or something you are paying by way of advance tax. But all the interest and the fees, whatever we have to pay by way of this in self-assessment tax. So self-assessment tax includes interest, tax payment, late fees, everything. Right? Now, please don't get confused that interest is paid on the shortfall of the advance tax. So why we are not paying? The question is not that. Uh, why the interest is to be paid? Because you have made the shortfall on advance tax. It doesn't mean that advance tax include the interest payment on shortfall. Obviously, interest payment and shortfall is to be paid by way of self-assessment tax. So whenever you are making self-assessment and paying, it is called the self-assessment tax. No such rule is there like 10,000 and all this. If your tax liabilities once crosses 10,000, then only the question of advance tax liability as well as self-assessment tax liability will arise. Unless if you are having positive tax payment but less than 10,000, then only the self-assessment tax liability will be arise. You have to pay only self-assessment tax before you file your return. Right? So I hope you are getting my points. Right? So here is a calculation I have given, right? So I'm not discussing in detail these calculations, right? So A, B, C, D, E, these are the way of calculation. So just I'm showing you one thing. If you are supposed to pay the self-assessment tax, it will include A and B. And B means total tax liability, as I've shown you, the 39,000 something, plus all the interest we have calculated under section 234 A, B, C, as well as the late fees under section 234F, whatever we have discussed. But it should be excluded all the TDS earlier deducted. If you pay any advance tax already, you are not supposed to pay self-assessment tax. So whatever the tax you have paid, say for example, for one person having tax liability more than 10,000, so he has to pay advance tax and he has paid, say for example, 60% of the advance tax, right? 60% of the advance tax. So rest 40% he has to pay by way of self-assessment tax, whatever we have done in our case. Now see, they have paid the up to 2,50,000 by way of advance tax. Only the shortfall amount they have to pay by way of self-assessment tax now, right? So if you have both the liabilities, first pay advance tax as much as possible. If you have any shortfall, then rest will be taxed or rest will be paid by way of self-assessment tax, right? Okay, one thing actually I forgot to tell here, for this specifically for 234B, if you are paying or having any shortfall on total advance tax payment, as we have done in our case, there is a shortfall 39,440, but at least you have paid 90% of your assessed income. I'm just giving you an example. Say for example, your total tax liability that is to be paid by way of advance tax in different installment is 1 lakh, but you have paid 90% of your total tax till that date at least, then no question of interest liability under section 234B will be imposed on you. It's a relief. Okay, but if it is less than 90%, then obviously 234B liability will be there. Now, if you see in our case, what is our liability? 39. What is our total tax liability? 2,50,000. Now 2,89,440, if you calculate 90% of 2,89,440, and it will be obviously less than the 90% of 2,89,440, whatever amount we have paid. So that is why the interest liability for 234B has arise. If it is at least 90% being paid, but not the total amount being paid, so then there will be no interest liability. And at the same time, in case of interest liability for the 15 June and 15 September date wise, if you are making shortfall, then also there are two relief for the first two installments. So by first installment, you have to pay at least 15%. Now the provision is saying that if you pay at least 12%, but exactly not 15%, then there will be no interest for the first installment. 15% at least you have to pay, obviously. But if you pay at least 12%, but it is you have paid less than 15%, then no interest liability for the first installment will be there. But if it is less than 12%, then obviously there will be interest liability. And for the second case, 45% total have to pay, including the previous payment of the first installment. But at least you have paid 36% of the total interest payment, including the first installment. Even in that case, there will be no interest tax liability or interest liability for the second installment also. Right? So it's a thing you have to keep it in mind whenever you are paying your tax, whenever you are computing your all interest liabilities and fees if applicable in your case. Right? Next thing that I am going to discuss, that is the assessment of return. Right? So assessment of return, basically of four types we will be discussing. Now four types of assessment are there. First type of assessment that is done, we have already know this, self-assessment tax. Now self-assessment tax is a tax. It is based on your own assessment. Actually, you or any income tax authority is not assessing your return. You are assessing your return, you are assessing your income, and you are paying tax. Right? So self-assessment. So self-assessment tax is paid if you make self-assessment. Right? So self-assessment is done under section 140A. Now here you just check, it is a voluntary in nature. That means those who are paying the tax voluntarily, you have to disclose this, or you have to not disclose, you have to assess the tax liability. And it is taxpayer initiated, no the authority initiated. When you have to, when it is applicable, before the filing. Before the filing, when you are filing your return, you are submitting your return. Before that, you have to assess your tax liability. Right? Taxpayer calculates his tax payable and pay the tax and interest fees as per his or her own computation. Right? What is summary assessment? Summary assessment includes section 143 subsection 1. Here the automated preliminary check. So here it is a way of summary. That means whatever we have done, we have make a summary assessment. We are just checking a summary. So it is done after the filing of return. Auto process for arithmetical error, correct, incorrect claim collection, TDS mismatch, etc. So understand 143.1. If you are making any mistake, so you can make a summary assessment and basically after filing your return. Now both of the summary and self assessment, it comes under, or it is within the purview of the taxpayer. Now the scrutiny and base judgment are under the purview of the authority, that is CBDT, or basically your assigned assessing officer. Right? Scrutiny assessment means whenever you file your return, the assessing officer will scrutinize your return under section 143 subsection 3, and they will in detail examine all these requisite sections and all these requisite details of your filing. If you suspects any under-reporting or suppressing of fact, then they can send you a notice under this section. So after checking or after scrutiny, if any default or if any misstatement or something else has been discovered by AO, or he suspects something, he can issue a notice and he can call you on a hearing for clear those issues, right? Sorry. Last type of assessment is base judgment assessment. Section 144, it is done. Now the AO has a discretion based on the assessment. So sometimes what happen, the assessee do not file, an assessee that does not file his return by himself. Even the date has passed, they at least they don't have the idea, or they don't have the due knowledge of the due dates and the deadlines. There's so many types of assessee in India. They are very reluctant about this. In that case, if you are not filing your return, or if you are filing your return but all the return or all the information disclosed, it is everything finds very unrealistic, in that case the assessee failed to file and comply with the notice, and also if you are filed but you are not responding to the notice sent by you or scrutiny assessment, so in that case, the assessing officer will give you a certain time period, 15 days, 20 days as per his discretion. And still, if you are not doing anything or not taking any action from your end, then the AO will make assessment based on his judgment. This type of assessment is called based judgment assessment. And you have to comply with it. You can't deny this, right? He has the utmost right to make assessment according to his understanding. If you are failing to do or failing to file your return, and as well as you are not responding to any notices you have received, right? So I think this thing or this assessment is clear, right? Now a few things regarding the TDS, right? So TDS means what? Tax deducted at source is the full form, right? Now why we need TDS? Let us first understand. TDS we need because if the person is paying you, so for example you are receiving salary, so your employer is paying you the salary, so employer knows that how much income you have, and if when the employer is paying you and the person is not disclosing the same thing, that how much he is paying to you by way of salary, the government at least have no way to trace your income, right? So TDS is a minimum rate prescribed by the Act or the different sections I have given here. There are so many sections, only 4 sections has been discussed here. So this rate of tax should be imposed on you earlier when it is just initiated or just it has been started on at the time of source. That is why it is given the name tax deducted at source. So when it has been generated at its source, directly the deductor or the payer that will deduct the tax, and after deducting the tax they will pay to you. So why this is done? Because to track or to trace your income from different sources. And whenever you will be filing your return, if your total tax payable is nil, all the amount deducted earlier by way of TDS, you will receive from all these things from income tax department. Even they are making delay, they will pay you interest, like as they are paying taking interest from you for non-filing or delay in filing return. At the same time, if they are collected TDS and they have not returned back to you in spite of your having zero amount of tax payable, then they will also pay you interest. So you will receive refund as well as payment of interest, right? They will pay you interest. So interest including refund. So as of now, we are only focusing on the 4 sections of TDS. As a matter of discussion, I will be discussing in brief. Section 192 is on the salary payment. So if any person having earning any salary, so then this section will be applicable. Who is the applicable person? The employer of the employee. They will take or they will deduct the TDS under section 192 on the salary, and they will make payment. There is no such threshold limit. That means up to how much it is free. Then there will be 1% TDS and all this. There is no such limit. Basically, what happens? Whatever the total tax on during a total year, first the employer will calculate. So, for example, your income is total 12 lakh. So, what will be your total tax payable or total tax? They will calculate, and on the total tax, they will charge, say, for example, 10%, and the 10% will be deducted every month So 20,000, so 10% on the total tax divided by 12 months. So every month they will pay or take a certain amount of tax and they will deposit by way of TDS on you. So actually for 192 there is no section or no rates but specifically given. It's a monthly deductible amount. It's a practice basically, you can say, for the 192 when you are paying salary. Now 193. Here the nature of payment, interest on the security. So if you are having any income from share oriented fund, mutual fund, this sort of thing, so then basically it is paid to a resident of India, and having income more than 10,000 from any post office or bank or any other thing, then 10% will be applicable as a TDS. So if you are having income, say for example 12,000 from dividend, right? So 10% will be net you will receive. Quote, do not other things will remain same. 10% considered as and 194B and BB is for winning from lotteries and crossword puzzle, and winning from resources 194B. Basically, if the total amount of receipt from all these winnings crosses 10,000, then amount paid to the when the winner is about to receive the amount, 30% flat tax will be charged on their income, and 4% uh, 4% the education cess will be added, health and education cess. So this is TDS deducted, and whenever you are filing, you will get refund if any. And this is also applicable for the 194BB, 30% tax, right? So whenever, say for example, commonly we have the winning from lotteries, right? So if you have income from winning from lotteries, then if you have income winning from lotteries, then 30% you have to deduct tax TDS, and then you will be receiving the rest portion, right? Okay, so can I get 5 more minutes? It's almost
Sure, sir.
time,
Sure, sir.
so I can
Mm.
conclude within 5 to 6 minutes, right?
Okay, sir. Okay.
Okay, okay. So the last thing that I'm going to discuss for today's session, that is uh, refund, right? So now what is refund? Refund means if you are, so I have discussed already the TDS provision. So if you are paying TDS, if your TDS has been deducted earlier, so you have the right of being a taxpayer that you can claim the refund if in. So before going to claim your refund, you have to know that what is your total tax payment, right? So say for example, your total tax payment is 50,000. Now, for all the different sources, you have some sort of TDS deducted. You have some sort of TDS deducted. So in that case, you can receive some sort of refund if it is exceeding your total tax payable. So your tax payable is 50,000. Say for example, earlier, whatever from different sources of your income, total 80,000 tax has been deducted by way of TDS. But your actual tax liability, whenever you are filing and you are assessing, it will come, say for example, 50,000. So 30,000 will be a amount that is you have actually excess paid to the income tax department by way of TDS. So you can claim the refund for this 30,000, right? So you have the right, being a taxpayer is entitled to claim a refund if they can demonstrate the amount of tax paid is exceeded the amount of legally payable or relevant tax laws. Under the Income Tax Act 1961, Section 237 provides that the taxpayer satisfy the assessing officer that they paid excess tax and they have the right to refund. So obviously, if they have paid excess tax, they have the right to refund. Who can claim refund? Any taxpayer, being in a capacity of either individual, company, firm, or any other entities, all the 7 types of person who has paid excess tax, they can file return and claim the refund. They have the right. Sorry, income tax scenarios, taxpayers who file return and show excess payment through TDS, advance tax, etc., or due to the relief granted on the appeal, they can claim. And how to claim? So the process is very simple. First, file your return, show what are the sources of income you have, pay the tax if any, and if the tax payable is nil, in that case you can claim the refund. Right? Just I am showing you one glimpse of the uh, ITR file, how we can get this. Just I'm showing you one thing, just a glimpse that you can at least understand that how to find out the return, right? I'm just showing you one file return. I think my screen is visible.
Yes, sir, visible.
Okay, so just see one thing. I was discussing about this TDS payment. So is a TDS we can claim in this way. And here, now see, whenever you are filing, they will say you that how much refund you can get, right? So now see the advance tax paid already. How much we know. Here is your total tax liability, whatever we have computed. If you just enter all your income details, by default, the income tax authority are using the different utilities. You can calculate, or you can give your input. It will be automatically calculated your total tax payable. Now, see, this is our tax payable. How much? 47,000 something. Now, how much TDS we have paid? 80,669. So we have paid more than our actual tax payable. So we can claim for the rest portion of 33,000 something by way of refund, right? So if you whenever you are filing, so you are disclosing all these incomes and all the things, then if you can claim, you can claim the return, you can claim the refund, and you can process for the filing, and it will be refunded very quickly. Nowadays the process of receiving the refund is very easy, so you can claim this refund easily, and you can get this return also very easily, right? So this is all from my end. Thank you so much for giving me this platform for delivering this lecture. Thank you.
Thank you so much, sir. It was really great session and the detailed explanation about the direct tax and how the people who are earning they can easily pay their tax by calculating their earning sources from this video. And the way you have showed the detailed example with mathematical calculations to calculate the tax and all the other deduction, it was really appreciating. Thank you so much, sir, for bearing time with us out of your busy schedule. Thank you so much, sir.
Thank you. Thank you.
Thank you, sir. So with this, we are concluding today's session. Okay, sir.
Okay. Okay. Thank you.
Okay.